this is Daniel Grady with Binary Options Strategy, and today we're going to be discussing some basic tricks to identify support and resistance levels. These levels are important for traders because they show areas the market might have trouble getting through and will bounce off of. If the market does manage to break through, they can indicate the market is making a strong move in a particular direction. Now, it's Saturday, so I'm not getting any live updates on my chart because the markets are closed. But this will make it easier for me to give a demonstration of how this works. I picked this piece of the chart because it's a great example and I can use it to simulate how you'd identify support and resistance levels in a live market. These levels are important for most traders, which is why you can find them on daily reports in a lot of market-oriented sites and on our daily review videos. Normally, it takes a lot of analysis to determine support and resistance levels, and there's a lot of math into it using fractals and Fibonacci series. But we're not going to get into that today because most binary option traders don't use those levels in their trading. Having a basic understanding of how they work should give you a leg up on other traders and help you get more options to expire in the money. And don't forget to check in on our daily videos so you can get the latest data on the market. Anyway, back to the chart. This is actually one of the cases where using Japanese candlesticks is not the most beneficial because it provides us with a lot of extra data that could give us a little bit more difficulty in identifying where the market's going. So what we're going to do is we're going to switch this chart to a line graph. Now, we're going to look for the next level after this move here. So we have a strong move in the market and there would be a period of correction afterwards and the market's going to make its next move. Alright, so after this move, the furthest down the market goes is here, okay? So this would be tentatively a support level. Now, if I was doing this as part of my daily videos, trying to predict where the market would go, I'd use a lot of more complicated things to determine where this was. But for the effects of this demonstration, let's say this is going to be the support level, okay? What I do is I get a horizontal line and drop it right here at the bottom of the level. Okay, so this is a support. This is the support level for this movement. Also, the highest the market goes is up here. So this would be a resistance level, which will also drop a support level. Okay, again, I mean, I would get into more details with this, with more math and other stuff, but we're doing this as a basic demonstration. So we switch the chart back to Japanese candlesticks, and now we see what happens in the market. If we move the chart a little bit forward, we see that the market again comes down and tries to push through the support level, but fails to do so and actually bounces back. Okay, so we had the market tries to come through here. The market also came down, bounced back and went up, and then again the market comes to this level and then tries to bounce back up. So as you can see, the way that you trade this particular indicator, well, it's not actually an indicator, but the way you trade this is when the market comes down and then comes back up off this support level, this is when you want to buy a call, because you can see you have a strong move in the opposite direction as the market tries to go up against the next resistance level. So not only did it bounce off here, which is where we identified the support level, and tried again here, we had another movement here, and if we move the market down again a little bit further, again the market tried to get down to here but didn't manage to get to it, but here it also went down through the support level and then came back up again. So this is one of the options that we have with the support level, is that the market will reach the support level and come back up, and this gives us a good opportunity to get into the market in a long position. In other words, for trading binary options, we'd be buying a call. But obviously the market's not going to stay in this range forever, and eventually it's going to break through, which is the second option that we have with levels. And that's a little bit further over in the market. We see that when the market closes down significantly beneath the level, we have what's called a breakout. And this means that the market's going to make a strong move in this case, if it's a support level, if it's a support level and it breaks through, then there's going to be a strong movement on the downside. So this gives us a good opportunity to get in on by buying a put. Okay, so how do you differentiate between when the market's just poking through and when the market's actually breaking out? Usually usually the market will close with a significant move to the downside. So here we have a bearish candle, and in this case you can see that the half of the bearish candle closed beneath the support level, whereas the other times when it came down and touched the level, it only poked through a small portion of the candle, poked through, and then it came back up again. If we go back a little bit further, also this one actually closed at the support level, and then we had a hammer, and we had a splitting top, which is also pretty indicative of that this would return back upwards. Okay, so but if we go back to where the breakout happened, there's a strong move to the downside, and again we'll be looking at, and again this is one of the ways we can use to identify a breakout. So here we've been discussing about a support level. The same principles apply when you're dealing with a resistance level, except it's just the opposite. When the market comes up and touches the resistance level, then you want to buy a put, and if it breaks through, then you want to buy a call. So anyway, hopefully you enjoyed this video. Thanks for watching, and happy trading.